Welcome back. You're watching Taking Stock. My guests today, Ashwani, Agarwal and Alroy Lobo. Alroy, the one hurdle or imminent hurdle seems to be the way food inflation is moving, and whether the Reserve Bank of India presses the trigger sometime in December and not even wait for January. Do you think the equity market is prepared for that, sees it coming and has priced it in, or could that be the trigger for some kind of an intermediate correction?
Yeah, I think the consensus is building up that anything to do with central bank policy would start emerging only in January. So anything earlier than that would be, a negative surprise for the market. Having said that, I think we are coming very close to, the Reserve Bank of India taking some action on inflation. Even though it is, supply-led, our sense is that as credit creation starts picking up, it would also, spur demand-side inflation. So rather than wait for that to happen and have the toxic combination of both supply and demand-side inflation, I think they would act definitely in January.
Ashwani, do you see that as a threat to the market's outperformance from here, or do you think since it's a known devil, the market may not react too violently?
I think, the monetary tightening is less of an issue. As Alroy had pointed out earlier on the program, it's the fiscal stimulus withdrawal, which will be indicated in February end, which will be of greater importance as far as the markets are concerned. A CRR increase of 25 to 50 basis points, which is really the view at this point in time, sometime between now and January end, is pretty much known. That would raise the shorter end of the yield curve, or push up the shorter end of the yield curve, but that doesn't have a significant impact on equity prices. Maybe 5-7%, but nothing more than that. The longer term issue is going to be what does the government do to bridge its fiscal gap, and what does it do about the fiscal stimulus, and that I think is something that the market is not thinking about and talking about right now. I continue to see a lot of bullish reports on automobile companies, on various consumer companies, which have significantly benefited both on the demand side as well as on the tax relief side that have been made available to these companies. So that's something that worries me.
The one feature, Alroy, which has characterized markets though in the last couple of months, as the Nifty has pretty much been range bound, is the mid-cap outperformance, or the outperformance of the broader market. How do you explain it? Is there genuine value seeking going on outside the large cap universe? Are people building positions in mid-cap sectors ahead of some kind of January allocation? What do you think is behind it, and can it continue?
I would say that normally when you fail to see significant value in large cap, the market definitely tends to get more broad-based, and I think that's what's playing out in mid-caps. But as the mid-cap valuations keep moving higher, that kind of valuation arbitrage gets closed, and that's the time you see markets correcting. My sense is that if you look across mid-caps, I don't think all mid-caps are cheap. One has to be fairly selective and take more of a stock-specific call rather than take a call that it's mid-caps versus large caps. I would like to play it by saying relative value rather than mid-caps versus large caps. So if you're getting relative value even within large caps, I think those are the sectors of stocks one has to be invested in. So it may come from mid-caps, it may come from large caps, but it's all a relative value game right now.
Ashwani, what's going on, you think, in spaces like mid-cap, IT, etc., which have been such big outperformers? Do you think the markets, the message is simply that large cap holds little value now, and if you have to be in stocks, you have to go look down the ladder?
There's a little bit of both. In the sense that there is absolutely difficult to find value in the frontliners, so you try and dig deeper and find value. So that is obviously one side of the story. The other thing is that there are some sector-specific situations as well. You mentioned IT in particular. If you think about it, many of the mid-cap IT companies are today in a much better position to grow their businesses as compared to very large companies like TCS and Infosys, who need much broader improvement in demand situation to rise up. Towards the middle of the year, we found that many mid-cap IT companies were trading at 3, 4, 5 times 1 year forward earnings with no gearing or net cash on their balance sheets. So they were very, very attractive. So I'm not surprised that they've done spectacularly well since. But the valuation gap between large cap IT and mid cap IT continues to remain pretty big. A lot of the mid cap IT, for instance, still trades at around 10 times current year's earnings as compared to large cap frontline IT companies which trade at closer to 20 times 1 year forward earnings. So that's the kind of a gap that you're talking about. Near the peak of the markets, we've often found that on aggregate, the mid-cap market trades at valuations which are very close to the frontline valuations within, say, a striking distance of 20% or so. Right now, that valuation differential on an aggregate basis is still larger. So my sense is that mid-caps will continue to do well because they offer a lot of value.
Alroy, the sector which has been an interesting one to say the least has been telecom. First the complete bust up and then the recovery over the last few sessions. Do you think the worst has been priced in by the market? Have they bottomed out?
I don't think, Udayan, that telecom sector will outperform the market in the near term. A bounce back was anyway in the offing given the kind of significant correction you have seen in the stocks in the sector. Clearly, I would say that market is yet to price in the fact that you could see losses emerging in certain companies in the sector. Some of the frontline companies could also see, a degrowth in their earnings. And unless, those numbers come in and, that gets priced into stock prices, I wouldn't say the sector has yet bottomed out. Yes, there have been some amount of bottom fishing after the correction, but after this, rise, I don't think, there's too much of upside left in these stocks.
What do you think, Ashwani? Is it a dead cat bounce or has the sector bottomed out amidst the gloom and doom?
Well, it's a very interesting one. Something we've looked at very closely over the last 2 weeks or so. My sense is that the stock price, let's say for the frontline of Bharti that you had seen at around 280 rupees, is very close to a very, very bad case situation or a very pessimistic scenario. Maybe, another 10% lower from there, say 250, 260. I don't really see the stock going way below that if you take the view of the next 1 or 2 years. So if you are an investor who has the ability to take a 5-year view and you can bet on who will emerge as a winner from eventual consolidation that will happen, buying at 270 probably makes sense, or, lower than that or whatever it is. But I agree with Alroy that over the next 3 or 4 quarters, there's going to be a lot of news that is not going to be very pleasant. So you have to have a very strong stomach for high volatility and possibly significant downside from stock prices presently trading. So I don't think the worst is out yet. And at the same time, at some stage, value will emerge. And this will be a great opportunity to invest for the long term for those who are able to ride out the short-term worries.
Okay, time for a quick break. Come back on Taking Stock for final comments from our 2 experts. Back in a minute.